Hi, welcome to my channel Too Irrational. I'm Pranay Sharma, and in this video we are going to see solution of CM1 paper A conducted by IAI Institute in March 2022. We are going to discuss each and every solution in depth, and if you want the solution sheet, please WhatsApp or Telegram your email ID to the number that I have posted below in the description. Let's get started. The question number 1 is an MCQ style question. Every MCQ style question is expected to be answered in just one letter, that is A, B, C or D. That's it. You don't have to explain any solution in that. So here we have Alan wishes to plan for a pocket allowance of rupees 5,000 per month for his daughter during her 4 years degree course starting from 1st January 2023. He is thinking of purchasing a deferred annuity where the deferment period is 1 year and pays 5,000 at the beginning of each month during the period of 1st January 2023 to 31st December 2026. Calculate the amount Alan requires to purchase the annuity as at 1st January 2022. Assume effective rate of interest of 9% per annum. So this is a very simple annuity style question. So let's see. First of all, we have 12 payments of 5,000 in a year, deferred for 1 year, that is why discounted by V. Then we have annuity in advance, payable for 4 years and 12 times a year. So we get 1,86,192.5. That the closest answer is option B. Let's go to question number 2. Question number 2, define the term discounted payback period and payback period. List the disadvantages of using discounted payback period and payback period as metric for evaluating the investment opportunity, and list the disadvantages of the internal rate of return as metric for evaluating investment opportunities. The discounted payback period for a project is the smallest time t for which the present value or the accumulated value of the income up to the time t exceeds the present or the accumulated value of the outgo up to time t. Payback period is the same as the discounted payback period, except that the present value calculation or accumulation is carried out using an internal rate of 0%. In other words, it is the earliest time for which the monetary value of the income exceeds the monetary value of the outgo. Disadvantages of DPP and PP. Neither the DPP nor the PP gives any indication of how profitable a project is, as they ignore the cash flows after the accumulated value of 0 is reached. The PP can give misleading results as it does not take into account the time value of money. There may not be one unique time where the balance in the investor's account changes from negative to positive. So there may not be a unique DPP or PP. Disadvantages of IRR. In some cases, it is possible for there to be more than one solution. In such cases, the smallest positive solution is usually used. If there are only inflows of cash, that is no outflows, the internal rate of return will be infinite. Usually, the equation of value cannot be solved directly to find the internal rate of return, and it is complicated metric to calculate and explain. So the question was very straightforward. Let's go to question number 3. So question number 3. A life insurance policy promises to pay a benefit of 50,000 at the end of the policy year of death to a life now exactly age 50 years, provided that death occurs after attaining the age 60. Calculate the expected present value of the death benefit assuming that the effective annual interest rate is 6% per annum and the mortality rate are based on 100% of the AM92 ultimate mortality table. So we have 50,000 payment given if the person survives for 10 years. So we raise to 10, 10p50, and then after that we have A60 directly taken from the AM92 6% table. So we get 8728.24, that is option A. Let's go to question number 4. In question number 4, a whole life annuity of rupees 500 per annum is payable annually in arrears to a life age 70 years. Calculate the standard deviation of the benefits from this annuity, assuming mortality rate of AM92 select and the annual rate of return of 6% per annum. So the variance of annuity is going to be 1 by d square 2a select x minus a select x whole square. And because the value was 500 per annum, we will square that value as well. So we get this formula and this becomes our variance. We wanted the standard deviation, so we will take root and we get 1719.45. That is option C. Let's see question number 5. So in question number 5, select the option which is equal to the function a due xn minus axn. So we need the difference between the temporary annuity in advance minus temporary annuity in arrears. So here I have written temporary annuity in advance and temporary annuity in arrears. You can see from this point to this point we have common values that will be removed when subtracted. We will be left with just 1 minus v raised to n npx. That is option C. Let's see the next question. Question number 6. A 3-state transition model is as below. So they have given the forces of transition symbols for each one of them: health to ill, ill to health, healthy to dead, and ill to dead. Assume that the transition probability are constant all ages with, they have given the values as well. A healthy life age 40 years exact takes out a 20-year sickness contract that provides a premium refund of rupees 15,000 if the insured remains healthy for the full duration of the contract. From this option provided below, select the expected present value of the premium refund at the beginning of the contract with the force of interest of 5%. So here a few people may make mistake. It's a force of interest. That means delta is given as 5%. Then this 15,000 is refunded only if the person remains healthy throughout these 20 years of the contract. So we'll say that 15,000 would be paid after 20 years if the person survives. That means stays healthy throughout those 20 years. So HH bar. So when we say HH bar, so we'll be considering only the healthy to ill as well as healthy to dead. So the transitions that are moving out of the healthy state will be considered. And we will have our 20 years of discounting. So as everything stays constant, we will get this finally, and the value becomes 1360.77. That is option C. Let's go to the next question. Question number 7. Describe the key characteristics of a health insurance contract. Describe income protection plan, critical illness plan, and long-term care insurance. So we have a typical health insurance contract lasts for 1 year. In return for premium, the policyholder is entitled to benefits which may include hospital treatment either paid for in full or in part, or cash benefits in lieu of treatment, such as a fixed sum per day spent in the hospital as an inpatient. So we are saying the benefit can be paid as the hospital treatment bill paid in full or paid in part, or maybe as a cash benefit given each day, each month, whatever, when the person is in hospital. In this case, a policyholder can be considered to be subject to the competing risk of death and of becoming sick. So that was about health insurance. An income protection insurance contract pays an income to the policyholder while that policyholder is deemed as being sick. If the policyholder recovers, the cover under the policy usually continues so that subsequent bout of qualifying sickness would merit further benefit payments. Premium for these policies would normally be regular, that is monthly, and would typically be waived during periods of qualifying sickness. So this was income protection insurance contract. Let's talk about critical illness insurance, which normally pays a lump sum on diagnosis of a defined critical illness such as cancer. Long-term care insurance, which pays an income contingent upon the policyholder, requires long-term care and hence supports the cost of receiving that care. Let's see the next question. So question number 8, first part, list the consideration for assessing the suitability of a model for a particular exercise. There are a lot of points when we are assessing the suitability of a model for a particular exercise, but you don't need to write so many. They have given 5 marks, so you can write about 5 to 7 points. I would suggest 7 points, any of these 7 points. So the objective of the modeling exercise, this is the most important stuff. The validity of the model for the purpose to which it is to be put, the validity of the data to be used, validity of the assumptions, the possible errors associated with the model or the parameter used not being a perfect representation of the real world situation being modeled, the impact of correlations between the random variables that drive the model, the extent of correlations between the various results produced from the model, the current relevance of the model written and used in the past, the credibility of the data input, the credibility of the result output, the dangers of the spurious accuracy, the ease with which the model and its results can be communicated, regulatory requirements. So you can write any 7 of these. The second part was very interesting. So we have a life insurance company has launched a new with profit endowment assurance product. The product has annual premium which can be 50,000 or 1 million or 1 lakh actually, 1 lakh only. The premium term and the policy term are 5 years and 10 years respectively. The sum assured is 12 times the annual premium. Benefit payable on death and maturity is the sum assured plus acquired regular bonus. The company has developed a model to calculate the reserves for this product using a gross premium valuation approach, and the table below contains all the outputs that this model has produced in respect of the sample model point. Analyze the output provided below and list all the issues that you can spot. You do not need to show any calculation as part of your solutions, but only describe the issue. So we see a lot of inconsistencies here. First is the number of policies cannot go more than 1, because once we sell the policy, we do not expect addition of people afterwards. The number of policies in the last year is not shown. The premium income is calculated according to 60,000, whereas they said it would be 50,000 or 1 lakh only. The expected premium income is not shown, mainly because the probability is not given for the 8th year. The policy is supposed to be 5 years or 10 years. We still have 5 years values, but we do not have the 9 year and the 10th year value to compare. The maturity outgo is given in year 7. It should be either in year 5 or in year 10. The expected death outgo should be calculated according to the 12 times of the annual premium. That should be either 50,000 or 1 lakh. An expected death outgo for 8th year has not been calculated, but the commission, that is usually some percentage of the premium, has been calculated even though we don't know how many people survive at time 8. Reserve at time 2 has not been given. Now this is most likely all the reserves at the beginning of each of these years. So actually the values of year 1 are not required because we don't keep any reserve at time 0, but we'll definitely require value here. So I think these are all the different points that you could specify, and that is what I have done in the solution. So these are all the points that I have just talked about. Let's see the next question. So in question number 9, a fixed interest bond is to be issued bearing coupons payable quarterly in arrears at the rate of 5% per annum. So we have quarterly payments. The capital is to be redeemed at 103 per 100 nominal on a single coupon date between 15 and 20 years. So we have optional redemption date after the date of the issue inclusive. The date of the redemption is at the option of the borrower. An investor who is liable to an income tax of 20% and a capital gain tax of 25% wishes to purchase the asset on the date of the issue. A net effective yield of at least 4% per annum is required from the transaction. Calculate the price that the investor should pay to purchase this much nominal, okay, 100,000 or 1 lakh, okay, nominal of the asset. So the first thing we'll do is we'll calculate what would be our optional redemption date. So for that we'll do capital gain test. So I4 quarterly payments, then 1 minus T1 C by R. So clearly that is less than I4. So we have capital gains. So the optional redemption date that we'll be taking would be the later date for calculating the price as the worst case scenario. Okay, so price calculation. We will have our basic formula 1 minus T1 C, annuity for 20 years, payable 4 times a year, plus the redemption at the end of 20 years, minus we'll have to deduct the capital gain tax. So T2, this is the capital gain discounted for 20 years. Rearranging, we get this formula and the price becomes 102.027 per 100 nominal. So for 100,000 nominal, 102.072. Let's see the next question. Question number 10, we have calculate A bar 2525 and A bar 2525 independent of each other, assuming AM92 ultimate mortality and 6% per annum interest. And in the second part, they are saying verify that the usual premium conversion relationship holds approximately between the two functions noted in part 1 above. So for the first part, our A bar 2525, it's an endowment value. Because it is payable immediately on death, we will calculate the death benefit separately and maturity benefit separately. So a term assurance value taken directly from the table book. So we will have A25 minus V raised to 25, 25P, 25, A50, V raised to 25, 25P, 25 calculated. Now this will be used also here. So when we say A bar 25, 25, that would be our temporary annuity, payable continuously. So we'll take payable continuously, and then convert it into annuity due, taking their values from the table, we'll get this value. Then for the second part, we have to prove that our 1 minus delta times A bar, the temporary annuity, should give us approximately this A bar 2525 assurance value. Okay, so you can see it is nearly the same value. So we are saying approximately equal. Let's see the next question. Question number 11, a loan is repayable by annual installments in arrears for 20 years. The initial installment is 50,000 and it decreases by 2,000 each year subsequently. The effective rate of interest over the term of loan is 4% per annum. Calculate the original loan amount. And then in the second part, calculate the capital repayment in the 12th installments. So for our original loan amount, we'll say 20 years of loan, that is decreasing. So first was 50,000, so 52,000 minus 2,000 increasing. So this becomes our original loan amount. Then to calculate our interest and capital component for the 12th payment, we'll first calculate what our 12th payment is going to be. This is our arithmetic progression. We will have A minus n minus 1 times D. That gives us 28,000. So our loan after 11th payment, the next payment is going to be the 12th payment. So this plus 2,000, we have 9 years remaining. So this becomes our loan outstanding. The interest component would be just loan outstanding into the interest. And the capital component is going to be the installment minus the interest component. So we get 21896.568. After the 12th installment has been paid, the borrower decides to repay the loan with the level annual installment which equals the 12th installment in amount. There will not be any further reduction in the installment amount, leading to a reduced term of the loan. The final installment will also be reduced to the level to clear the debt. Calculate the remaining term of the loan, then calculate the final reduced payment made to clear the debt, and calculate the total interest paid by the borrower during the term of this loan. So the loan after the 12th repayment is going to be loan after 11 minus the capital that was repaid in the 12th installment. Now that is supposed to be paid off by level installments of this 28,000 for the rest of the n years. We have to figure out those n years. So the n becomes 5.26. So the loan remaining term is 6 years. Here, if you have written your loan remaining term is 5.26, you will get it wrong. At least 1 marks would be deducted, because you will not be paying off the loan at 5.26 either at time 5 or at time 6, because we have annual repayments. So at time 5 the loan was not completely repaid, so at time 6 is where the loan would be completely repaid. Now you have to calculate also the last reduced repayment. So first of all, I will calculate what would be the loan outstanding after 5 years using the retrospective method. So this is a retrospective method, and I get this much loan is outstanding after 5 years, and the final repayment would just be accumulated for 1 more year. So we get 7641.03. Now for the total interest paid, first of all, we'll say it would be total installments minus the total loan amount. We know the total loan amount would be this much. We have to figure out how much is the total installments. So for the first 12 payments, we have decreasing amount. So I have taken the sum of arithmetic progression here, n by 2, 2a minus n minus 1 d. Then for the next 5 installments, we had 28,000 same, and last installment would be this much. So this is the total amount that we have paid. So the interest out of that would be this much. Let's see question number 12. An insurer sells a decreasing term insurance policy with a policy term of 15 years and an initial sum assured of rupees 300,000 to lives age 50 years exact. The sum assured decreases by rupees 15,000 at the start of each year, starting from the second policy year. The death benefit is payable immediately on death. The premiums are payable annually in advance throughout the term of the policy. The office calculates premiums using AM92 ultimate mortality and interest rate of 4% per annum. The initial expense of 500, renewal expense of rupees 50 at the start of each year except the first policy year, and a claim expense of rupees 800. Using P for the annual premium, write down the future loss random variable for the policy at the start of the term and also just before the payment of the 10th premium, assuming the policy is still in force at that time. So whenever we have a term assurance, we have to take into account what happens when a person dies within that term and what happens if the person does not dies within that term. So here, because we had decreasing, we have 300,000 and 15,000 decreasing, so I have added that together and then subtracted later on. Plus we have 800 as our claim expense, and because the payment is immediately on death, we have V raised to T50. But the decrease is going to occur every single year, therefore we will have K50 plus 1, and payment again decreasing. The payment would be paid immediately on death, so V raised to T50. The initial expense is 500, but I have also deducted the renewal expense of the first year here because I have taken an extra renewal expense here in the first year as well. So therefore I am not reducing the first year here, and that is why I have 450 here. This is our premium minus the renewal expense payable annually in advance. Now, if the death does not occur within the first 15 years, then we will have our initial expense, premium, all complete 15 years of premium paid, as well as the renewal expense paid. Now, the same thing we have to do just before the payment of the 10th premium. So we are left with 6 more years. Age is 59. So I have calculated what would be the payment. I have added 15,000 to it. Then we have our claim expense. We will not have our initial expense. We will have premium minus the renewal. And if the payment does not, if the death does not occur within those 6 years, then this would be the loss equation. Second part, calculate the office premium, and the third part, calculate the gross premium prospective reserve for the policy just before the payment of the 10th premium. Also clearly mention the assumptions made for the reserving basis. So using our equations above, you can make the equation for premium. So ADU 50, 15, 315,800. So the death benefit and the decreasing as well as the claim expense payable immediately on death minus 15,000 increasing again payable immediately on death. 500 is our initial expense and 50 renewal expense. Here you can see I have subtracted minus 1. You can rearrange and you will again get 450 here and 50 ADU 5015 here. Finding each one of these values, we will get that our P would be 1094.12. For the reserve at the end of the 9th year, again the values, same thing. For the benefit, the year will be, the age would be 59 and 6 years left. No initial expense, but premium minus the renewal expense. So this is our prospective reserves, and we'll get reserve as 707.42. The assumptions will say all mortality, interest and expense basis of pricing is used for reserving. Let's see the next question. So question number 13, explain the difference between the profit vector and a profit signature. So we'll say profit vector gives the expected cash flow at the end of the year per policy in force at the beginning of the year. On the other hand, the profit signature shows the expected cash flow at the end of the year per policy in force at the policy inception date. So we have a life insurance company issues a 4-year unit-linked endowment policy to a life age 50 exact, which has a level premium of rupees 15,000 payable annually in advance throughout the term of the policy or until earlier death. The company uses the following assumption in carrying out the profit test of this contract. Risk discount rate, interest on the non-unit fund and mortality is given to us. In addition, it is assumed that at the end of each of the first 3 years, 10% of all the policy is still in force, surrender. So surrender is possible only at the end of the year. We do not have multiple decrements, only death decrement works throughout the year, and surrender is possible only at the end of the year. For this contract, the profit vector is as follows. Calculate the profit margin for the policy on the assumption that the company doesn't zeroize the future expected negative cash flows. So we don't have to do any other thing. We just have to do the profit testing part. Here I have calculated the all decrement values, AQXD, that would be directly from the death. Okay, AQXS would be 1 minus of AQXD into the QXS, that is the 10% surrender rate that they have said, and then calculated APX by saying 1 minus of this minus this. So you could have directly calculated this APX by saying it would be 1 minus of QXD into 1 minus of QXS. That would have directly given you this value. So you could have directly calculated this value as well, because we don't require the exact values of AQXD and AQXS. We will require T minus 1 APX. That would be first year we will have 1, second year would be exactly same as the first year value, next year would be multiplication of these two, next year would be multiplication of these three. Then for profit testing, we'll say profit vector T minus 1 APX, profit signature would be multiplication of these two. Then we'll calculate the discounting factor according to the risk discount rate, and net present value will be multiplication of these two. Total value is this much. Expected present value of premium according to again the discounting factor here and T minus 1 APX. The expected present value would be this much, and our profit margin comes out to be 3.73. Third part, suppose the company sets up reserves so that the product is self-supporting. Select the reserve revised cash flow from below option under this scenario. Now, because this is an MCQ style question, you should answer only in ABCD. You don't have to show any of these calculations. Like here, clearly first year is positive, but second, third and fourth year all are negative cash flow, so we'll have to zeroize them. So calculate the reserve that should be kept at the end of the third year. That would be cash flow or the profit vector of the fourth year divided by 1 plus I. Then your non-unit cash flow at time 3 would be non-unit cash flow at time 3 minus the reserve into reserve kept is only for the people that are alive in that particular year. So accordingly you will have to calculate, take this, calculate the reserve in the second year, again do the same thing for the second year cash flow. You will get another negative, do it for the first year as well, and your first year cash flow would be this. So finally we are getting the option B, that would be 1553, and all others would be 0. Then for the last part, calculate the profit margin allowing for the cost of setting up these reserves. So we have to calculate now profit margin using this profit signature. We have profit signature, profit vector actually only in the first year. So profit signature will be same as profit vector. So all we have to do is discount it for 1 year to get our net present value. So net present value would be this much, 1444.651, and calculating the profit margin using the same expected present value of expected present value of premium as before, and we get our profit margin as 3.09%. So overall the paper was very straightforward, although I would have liked a little bit less number of theory questions, but I think they tried to make the questions easier for us to type. So we had a lot of MCQ style questions here. Overall, the paper was easy and could be easily solved in 3 hours and 30 minutes. If you find any mistake in my solution, please write down in the comment. I will pin them so that others can see them too. I'll be making video for CM1 paper B as well. So do like, share and subscribe so that you get notification for that video as well. I will see you in the next one.